All right, what's going on, my fellow wealth creators? Matty Ice here. Welcome to another training where we are going to have a lot of fun in this one. Probably even more fun in the comments section later on down the road, because I can picture some of the comments that I'm going to get from people in the IUL industry. It's going to be a lot of fun. But this video, I'm going to be breaking down all the reasons why I really do not like IUL. And I thank my lucky stars every day that I did not buy an IUL, because I almost did. When I started going down the infinite banking rabbit hole, a lot of what is sold, the majority of what is sold is IUL. And so I almost went down that road. But luckily, I wanted to do my research before I put a significant amount of money into this thing. And I started to learn how it works. And you know what was really frustrating the further down the rabbit hole that I went is that all the original content that I was watching and listening to about IUL, it was all positive. It was all about how amazing this product is. Nobody ever talked about any of the risks and any of the things that can go wrong. And if they did, they just kind of brush it off like, that's not a big deal, whatever. They make it sound like it's not something we need to worry about. But it absolutely is. Like when I started learning how the product actually works, and I listened to other people like pushing back against IUL, I was like, okay, that makes sense. Let me look into this. Let me look into that. And eventually, the whole dividend-paying whole life insurance became a no-brainer to me. Just once I understood how it worked, and then when I understood how IUL worked, I wanted nothing to do with it. Now, I want to be clear here. I would never tell somebody to never buy an IUL. I wouldn't tell you that, okay? Because I don't know what your goals are, what your financial situation is, what your risk profile is, or your risk appetite, whatever. My problem with this is that I don't think 99.999% of people who buy an IUL actually know what they're buying. I don't even think most IUL agents know what they're selling, okay? That's the biggest issue that I have with this. So if at the end of the day, after this video, after all the things I'm going to show you that can blow up in your face with an IUL, all the potential problems and risks involved, if you understand that, you understand what you're putting your money into, and you want to move forward with it, go for it. You won't get any pushback from me, because at the end of the day, you're an adult. You can do whatever you want with your money, whatever you think is best to help you reach your goals. And if that's an IUL, fine. Make sure you know what you're putting your money into. That's my only ask, okay? That's what this video is all about. I'm going to break down some of the things that were just massive red flags for me when I was learning about IUL, and I started going down the infinite banking rabbit hole, because these things can be really dangerous. Now, can they work if they're set up correctly, which most of them are not? Then, and also you don't over leverage them. Can they work? Sure. Maybe. I don't know. For me, though, I'm not willing to roll the dice with my hard-earned money on a maybe. I got this great analogy from a mentor of mine. He said, if you're about to get on a flight, all right, if your plane had a 5% chance of crashing mid-flight, would you get on the plane? I wouldn't, right? Well, then the question here regarding IUL is, if your IUL had a 5% chance of blowing up in your face during retirement, where you need the money the most, do you want to take that risk? What if it's 10%? What if it's 50%? I don't know. Like, we don't know what the percentage of the policy failing is, and not even just the policy lapsing, right? Because IUL agents will push back on this and be like, yeah, but you got the overloan protection rider. We got this rider to protect it from lapsing. Fine. Okay, maybe it doesn't lapse, but now you're 77, 80 years old, and you were relying on all of this fake income that your IUL agent told you were going to get, that you're not going to get now because your policy has been destroyed. It did not perform. So what do you do without all that income, right? So there's so many things that can go wrong. That's why it doesn't fit. It doesn't work for me. But if you have the risk appetite for it, fine. Just know what you're getting into, guys. All right, so we're actually going to go dive into a real life IUL illustration that I got from a friend of mine. It's a Transamerica illustration, and I got his permission to use this. Shout out to you, my friend. Thank you very much. You know who you are. And there's some specific parts of it that I want to cover. Some of the fine print that it's just important to read Okay, because again, a lot of the time, these IULs are sold like these amazing products where nothing can ever go wrong. You get upside potential, downside protection in the market. Why would you not want that, right? It sounds amazing. You get all this income and stuff it looks good on paper, but what happens in reality? Another mentor of mine says, life doesn't happen on a spreadsheet or an illustration, right? What happens in reality, right? That's what we're going to break down. And then also, I just got some bullet points over here to just keep me on track. The other thing we're going to finish up with, so please make sure you stick to the end on this, guys. All right. I'm going to talk about why IUL is actually pretty pointless. And if you're an IUL agent watching this, just hear me out, okay? If you could get upside potential in the market with downside protection using a whole life product, a whole life policy, so you have all the guarantees, all the protection, all the certainty, all the safety of whole life, you get that upside potential, downside protection, but without all of the potential issues with IUL. Why would you pick an IUL? Why not go with the whole life option? And I ask my IUL agent friends here, why would you sell IUL when you for the upside potential, downside protection when you can do almost the same thing with a whole life product? That's my question to you. We're going to break that down at the end of this video. I might do a separate training on that, put it in the description. But either way, I will bring it up at the end, and we'll do just like a quick breakdown of it. But something to think about, right? So I want to start with, let me go ahead and share my screen. Let me pull up the first page of the illustration that I want to talk about. It's so one of the issues, let's start with the first issue I have with IUL is you hear IUL agents say that cost of insurance is not an issue. Okay. And it's so misleading, and it's a half truth when I hear IUL agents say that your cost of insurance is very, very low. It's the only, like, I've even heard them say like IUL is the only product or life insurance product where your cost of insurance goes down as you get older. That is a lie. It's a half truth, guys. And I'm going to show it to you right now. There's a difference between cost of insurance and net amount at risk. When they say that your cost of insurance is lower as you get older, they're talking about the net amount at risk. But the net amount at risk is based on how your policy performs. If it doesn't perform and your net, and also how it's designed too, whether it's level or increasing, that makes a difference too. But even still, depending on what your net amount at risk is, which is the death benefit minus the cash value, that's the amount of insurance you're charged on. Okay, so that can fluctuate, that can go down depending on how the policy is designed and performs long term. However, it is a lie to say that your cost of insurance goes down as you get older. I'm going to show it to you right now. So we're inside of the illustration. This is a breakdown. These are the guaranteed maximum monthly cost of insurance rates per $1,000 of life insurance. Now, I'm 35, so we'll just start at 35 here. And you can see it's pretty minuscule. Like, we're not too worried about the cost of insurance right here, right? It's not bad. But IUL is built on annual renewable term, okay? Also a big issue that I have with it because, this is why. Because starting at age 35, my cost of insurance is negligible, right? But what about when I'm 70? Because that's where the real issues with these policies start to show up, is when you get older. It's not in the beginning years when you have it set up and you're in your accumulation phase, whatever. When I'm 70, though, it went from 0.11, so 11 cents, to $1.50. That's more than a 10x, guys. Then what about when I'm 76? It almost doubles. Okay, so your cost of insurance increases significantly as you get older. Now, what's the problem with this? Where's the risk? Okay, these are really complicated products. I'm trying to bring it all together here. The problem is when you have 0 years and you're taking income later on down the road, when you're older, that cost of insurance has to come from somewhere. Where do you think it comes from? Because you're not making you're probably not, most likely not making premium payments at 70 years old, right? So it comes from the cash value. And if you have a 0 year and your cash value drops, but your your death benefit doesn't, like, you don't lower your death benefit with it, your net amount at risk increases, and now your cost of insurance has increased significantly as well, like the amount of insurance that you have to pay on. Okay, so it becomes this, it can become this downward spiral when you have these 0 years. You'll hear agents talk about 0 being your hero. Okay, well, you might not lose money in the market because of that, but you can absolutely, and you will lose money in an IUL when you have that 0 year, when you're older and you're not making premium payments. You don't get all the cash value, that credit that the illustration showed you. Okay, that cost of insurance has to come from somewhere, guys. And you just look at this. I mean, when you get older, that's where the risk with these products are. Look at how expensive the insurance gets as you get older, and people are living into their mid 80s, 90s, mid 90s, right? I mean, this can just, a couple of down years, couple of 0 years, and this can blow up in your face. So I want to put that to rest, the cost of insurance thing, argument that cost of insurance doesn't go up, it gets cheaper as you get older. Wrong. You see it right here, right in the illustration. Cost of insurance gets more and more and more expensive as you get older. It's the net amount at risk that can fluctuate, but if that goes up, this number is really going to start to eat into your cash value and becomes a downward spiral at that point, guys. So that's one of the big reasons I don't like IUL. It's built on annual renewable term. You have an ever increasing rise cost of insurance, and that has to come from somewhere when you don't get credited. Now, that actually leads me to probably the biggest issue that I have with IUL is the illustration. Okay, so let's go to this part. This is so frustrating for me because it just doesn't make any sense. IUL illustrations illustrate like a CD product, certificate of deposit, because it shows you getting credit every single year. Guys, when was the last time the market went up every single year? I don't care what the average is with this. You can't apply an average rate of return every single year because that's not going to happen. What happened? Well, you know what? We're just going to get into it, okay? The first thing that I want to show you guys here, and even the average rates are misleading, and this is exactly why. Look at this. Look back period for illustrative purposes only. The IUL policy was not available during all the time periods shown. That's interesting. Caps are subject to change, so they can fluctuate the caps. The current cap rate on this one is 12%, but that can go down as well. They're subject to change, will be different over different time periods. All right. I'm going to, what was the part I wanted to? Oh, yeah, right here. Okay. Monthly deductions, this part right here. Monthly deductions and other policy fees and charges are not taken into consideration with this look back period. So right here, when we get these averages here, 7.62 to 8%, that's not net of expenses, fees, costs, charges, which can be pretty significant in an IUL. Okay, so what is the actual average rate of return here? It's just very misleading. So when you read the fine print, guys, and you know, past index performance, not an indication of future index performance, really. So then why are we using it? You know? Anyways, so that's with that said, let's scroll down. I think it starts in 102 here. Yeah, okay. So here we go. Here's the actual breakdown of the illustration. Okay. All right. So the first one is the guaranteed illustrated rate. So one of the things I'll hear IUL agents talk about is, oh, you know, IUL has guarantees too. Yeah, it's pretty useless. And again, I will say that this policy was horribly set up. It was set up for max commission to the agent. So it was pretty bad. But even still, when it's designed properly, the guaranteed illustrated rate, I mean, basically the only guarantee within this guaranteed column is that it's guaranteed to lapse. That's it. Don't believe me? Look, it lapses at 61, guys. See this right here? See where it stops? Yeah, your policy's gone. So the guaranteed stuff, completely useless. Because if you were to buy based on the guaranteed assumptions, you would never buy an IUL. And then when we compare that to whole life, yeah, it takes a long time to, in the guaranteed column, it takes a long time to break even, but you'll never see a whole life policy, even if it's designed poorly. You'll never see a whole life policy lapse in the guaranteed column, ever. All right, so under this assumption right here, or this part of the illustration, the policy lapses at 61. Great. Okay, but let's, it's probably the absolute worst case scenario. I'm not gonna bash IUL because of its guaranteed stuff, but I'm just pointing out that it's completely useless. All right, now, the next illustration we have here is 3.5%. So we're being like ultra conservative here, I guess, right? This one lapses at 93. So it still lapses. And this is assuming premium payments every single year, and it doesn't show income. So factor those two things in. When does it actually lapse? Probably a lot sooner. But here's my biggest issue, guys. What is this showing us? Policy value. Actually, let's start at the beginning. Okay. All right. So again, you can tell it's poorly designed because there's zero cash value in the first, or cash surrender value in the first 3 years. Yeah. So pretty bad. But anyways, policy value. Look at this. It's showing a 3.5% credit every single year, as if it's a savings account or a CD. That's not going to happen. Now, I will say that because the interest rate is quite a bit lower, then could we maybe get close to this? Potentially. But where IUL agents typically sell this is, let's go to the next one. All right, now we're at the 7%. So what I hear these days is 6 to 7%. That's conservative for IUL. I had one IUL agent send me an illustration of like 5.6% or whatever. It's like that was the worst case scenario. Really? Is it? Maybe, but you're rolling the dice, guys. Here's my problem is when this is used to sell IUL right here, this part of the illustration, it's showing a 7% credit every single year, uninterrupted. That is not going to happen, guys. Okay. Now let's try to simulate this. Okay. Hypothetical scenario in the future. Let's say I'm 70 years old and I want to start taking income. Okay, great. So first off, again, it's showing premium payments each year, and which we're not going to do. It's showing crediting every year, which is not going to happen. But let's do the math on this. Okay. Like you can see the policy value increasing every single year. All right. Now, what happens when I don't, let's say I get a 0 year at 70 years old and I'm not making premium payments anymore. Okay. So first off, the cost of insurance, whatever my net amount at risk is, that's going to get taken from the policy value. So I lost money in my IUL right there. Not to mention, if I have been taking loans before 70, the interest, where do you think that comes from? Comes from the cash value. Okay. But the other problem, though, with the 0 year is I don't get the increase, but like I don't get the credit that year. And that comes out to, I'm just going to rough estimate here, $14,000 in cash value that I do not have now in retirement. That is going to have a massive impact on the end result of my policy. So how can you actually project lifetime income, which actually that's another thing we're going to talk about. How can you project income every single year for the rest of somebody's life on a product based on the stock market where when they have a 0 year, which they're going to have, you're going to have multiple 0 years, guys. It's just the nature of the stock market. The stock market does not go up every single year. Okay. So if you have multiple 0 years and you're not getting the credit, plus you have cost of insurance, plus you have the interest working against you, you don't see where that can kind of blow up in our face later on down the road. And even, here's the thing is even if the policy doesn't lapse, okay, let's say you turn on your overloan protection rider, which I'm going to do a completely separate video on. Okay. That basically prevents your policy from lapsing due to the loan balance, right? Which they, in this illustration, it shows that depending on your age, they take 5% of the remainder of your cash value in order to turn that rider on, kind of add salt to the wound a little bit, but whatever. All right. And let's say that does prevent your policy from lapsing, even though it still doesn't prevent your policy from lapsing due to cost of insurance. But let's say in a hypothetical scenario, it doesn't lapse. Well, right, but now all of your income is gone from this product. So if somebody showed you earning, I don't know, taking 50, 75, guys, I had an IUL agent show me $212,000 per year starting at age 65 for the rest of my life. If I believed that and I bought that product based on that, and then my policy blows up in my face or starts to at 70, 75, I have a few down or 0 years, and now I don't have that income, think about the impact that has on your life at that point, your retirement. If you are relying on this income and it doesn't happen, even if the policy doesn't lapse, you don't have this income stream anymore and you're 75, 80 years old, whatever, what are you going to do? How are you going to plan for that? I mean, I hope that this is not your only source of income in retirement, because at that point you're screwed. I mean, you have Social Security and all that stuff, whatever. But, you know, there's so many things with all the things that can go wrong. Even if the policy doesn't lapse, you're still out the income. But like, that's why, it's one of the reasons why showing an IUL growing, being credited every single year, not to mention that when IUL agents show income being taken, they're showing positive arbitrage in that loan balance as well. What happens with that when you don't get a 0 year? What happens when you have a loan balance of $500,000, $1 million, however much you've been taken, okay? And you've got a 5% interest rate? That has to come from somewhere. What is that? Yeah, it's $50,000. Where's that coming from? Cash value. You see what I'm saying here, guys? So look, and I'll hear, I know IUL agents can be like, well, you're talking about the worst case scenario. Well, no, this is actually real life. These things can happen. The market can go down. People do get old. The cost of insurance does increase. Like, where am I going wrong here? Please let me know. And here's the thing. I'm going to say it again. If you understand this now and you still want to move forward with an IUL, go for it. I don't know what you see that I don't. I want to stay far away from these products. But this is my biggest issue right here with IUL, is the credit every single year as if it's a CD product, or as if the stock market's going to go up every single year. That is not going to happen, guys. It is going to have a dramatic impact, a significant impact on your cash value later on in life and how much income you're able to take. So be very careful with it, please. What else? Oh, yeah, that was another thing I was going to bring up here. I've literally heard IUL agents say that you can never lose money in an IUL. I don't even know how that's legal. I think I still have the video. I was watching it the other day. It was probably a couple months ago now. I just haven't uploaded it yet. But I was doing a breakdown video, and this guy was teaching people about IUL, and he said, you can never lose money here. And I couldn't believe those words came out of his mouth. I don't know if it was an accident or because he's since taken the video down. So maybe it was. I'll give him the benefit of the doubt. But you can't say stuff like that. That is so misleading, not to mention probably illegal. Guys, you can absolutely 100% lose money in an IUL, and you will in your later years when you're older. You're not making premium payments. You're taking income. Your cost of insurance is a lot higher. Your cash value will go down. Now, how much it goes down depends on how old you are, depends on your net amount at risk, how the policy was designed. There's so many moving parts. Like, this is not a simple product. It's not as simple as just saying, yeah, you'll make some money when the market goes up. It'll protect you on the downside. And you also have a permanent death benefit. It's not that simple, guys. Like, there are so many moving parts to this product that, I mean, you almost have to be your own money manager to manage this and make sure that it works. And if you want to do that, fine, whatever. The other thing that I want to bring up here really quick, actually, you know what? I want to talk about the guaranteed retirement lifetime income benefit rider. Let's talk about that. That's gonna be fun. I was kind of getting into it with an IUL agent the other day about this. All right. So I found this from National Life Insurance Company. Okay. So, or National Life Group. All right. So this is a lifetime income benefit rider. Now, I want to read the fine print for you here. Okay. That's all I want to do. All right. Now, that, when I say lifetime income benefit rider, like you can get guaranteed lifetime income, that sounds pretty good, right? Sure, captured my attention. Income you cannot outlive. Okay, well, it says here you can exercise your lifetime income benefit rider during retirement, receive income for the rest of your life, guaranteed. Oh, but there's a little fine print notice here. Let's read the fine print. Lifetime income benefit rider provides a benefit for the life of the insured if certain conditions are met. This is not like an annuity where you're just transferring risk to an insurance, a life insurance company. Maybe you've built up, you've accumulated a good amount of money in your 401k, as an example, and now that you're ready for retirement, you want to secure that. You want to take some volatility off the table, and you want to create a secured income for retirement. You take some of that, move it to an annuity, good to go. It's guaranteed for life, no questions asked. Okay. This needs to have certain conditions met. This is based on a product that assumes you're going to get 6 to 7% every single year. Keep that in mind. All right. These conditions include, but are not limited to, the insured's attained age being between 60 to 85. All right. The policy has to be enforced, or has been enforced, for at least 10 years, 15 years for select policies. Okay. So again, it's not like an annuity where you can do a single premium annuity and get income within 30 days, like immediately. Listen to this, guys. Insufficient policy values, right here. Insufficient policy values, outstanding policy loans, and other considerations, whatever that might be, may also restrict exercising the rider. So again, I ask you, are you willing to roll the dice on stuff like this? Are you willing to put your retirement on the line, roll the dice with your retirement on stuff like this? Where, again, if you are assuming that you're going to turn on this lifetime income benefit rider at 70, whatever, regardless of the age, could be 65, 70, anywhere in that range, and your policy doesn't meet the requirements necessary to turn that rider on, what are you going to do now? Well, the answer, the argument, I guess, would be, well, you could still take policy loans. And that's true. You can do that. But it comes down, this is the biggest, these are the biggest issues I have with is how it's presented and sold to people. If you were sold that you were going to get this guaranteed lifetime income, and now you can't even turn that on, but then also your policy, if you're taking policy loans, your cost of insurance is going up. You have a few down years, and let's say you took income for a few years or whatnot, but now you can't anymore because you have to turn on your overloan protection rider, or who knows what goes wrong. Okay, again, you were preparing your retirement, you're planning your retirement around this asset, this vehicle, and it didn't work out. So what are you going to do now? So, always read the fine print, guys. So this rider sounds really good. Maybe it is if you can actually turn it on, but you might not be able to. Exercising the rider and receiving an income benefit will reduce the policy's cash value and death benefit, which that would happen with like if you're taking policy loans anyways, and may terminate other riders or reduce their benefits. So you might lose all of your living benefits as well. So something to keep in mind. All right, guarantees are dependent on the claims paying ability of the issuing company. That's a non-issue. All right, so a lot of fine print in these products, guys. Please, please, please make sure you understand these things and ask your agent about these things. See what they say. Maybe it's not as big of an issue as I'm making it to be, because look, like I told you in the beginning, my risk appetite is pretty low. I don't like to take a ton of risk with my money. I don't mind taking risks, but I want stuff that I can control, like things that I can work in. I can get my hands on it, whatever. I can control. I can help control and dictate the outcome of that risk, of that opportunity, right? There's just too many things that can go wrong here. All right. Now, lastly, before we get into why IUL is actually, even after all this, like, this is fun for me breaking these things down, but even after all this, why IUL is pretty much pointless, because there's a whole life alternative. I do want to just address a couple of things really quickly, and it's the crazy strategies that I hear some agents talking about built around IUL, and there's two that come to mind. I'm not going to like completely call them out. I will do. I've got videos on them, breakdowns. You can go watch it, but where one of them is using premium financing, basically a bank loan to finance your IUL. So now we're adding leverage. It's like 3 times leverage, 3 to 1. I can't remember the name of the company. It's I'm drawing a blank on it. Kaizen. I think that's it. I probably just sounded like an idiot there, but that should hopefully ring a bell. Anyways, you're using leverage where the bank is making your premium payments for you in addition to whatever premium payments you're making. Like you have to fund it for a certain amount of time. But now you have this loan building up in order to finance this product. And again, what happens if it doesn't perform the way that it illustrated? Well, now you have this, you already have, you're basically already leveraged to the hilt here because you have this bank loan that you now have to pay off in addition to maybe now you're taking policy loans and now you have that loan balance to worry about. Like we're adding leverage to a product that already is inherently pretty risky. There's a lot of things that can go wrong with it. Why on earth would you do that? Why would you recommend somebody to do that? Premium financing is something that is usually reserved for people with like 10, 15, 20 million dollars that can weather the ups and downs of certain economic conditions and markets and things like that. But you know, if you're, I don't remember what the minimum was. I think there is a minimum. Like you can't just put like $100 or $200 a month in. But even still, adding leverage to this, plus you're going to be taking policy loans later on down the road for income. Oh my gosh, dude, that is crazy to me. I don't like, why on earth would you recommend that to somebody? That's nuts, my opinion. The other one was putting all of your income into an IUL and then taking policy loans to pay all of your expenses. What? Why? No. Again, that's just not for me. I suppose if you manage it like a hawk, then maybe that could work. But why are we setting up policies to do that? And I even heard them say that you're making money on the loans as well. In addition, again, it's that positive arbitrage. But what happens when that positive arbitrage doesn't happen? When you have your down years, when you're 70 and your cost of insurance is really high and blah, blah, blah. All right. The whole conversation is a little exhausting sometimes. It's just like it doesn't make like some of these things just really don't make sense to me. There's so many red flags. I don't know why anybody would do this, but yeah. Anyways, I'm gonna pause this really quick. I want to pull up just a quick slideshow breaking down how this whole life alternative works. Because I think like once you see this, guys, once you know this exists, like I didn't know this existed until a few months ago. A couple of months ago. Once I knew that, saw that this existed, I was like, well, what's the point of IUL? We get the same upside, potential, downside protection without all the problems, right? I think you're going to come to the same conclusion. So give me 1 second. Let me pull that up. All right, here we go. Let's rock and roll. Okay. So here's how it works, guys. So you know how you have that 0% floor or whatever in IUL? Well, that's you get a guaranteed rate of 3.25% with this particular whole life product at the time of this recording. Every whole life, mutually owned life insurance companies participating whole life policies, that's what we're looking for. They have a guaranteed growth rate. It's usually between 2 and 3.25%. So this particular product has a guaranteed growth rate of 3.25%. No matter what, even if the market doesn't go up, even if the market goes down, your cash value is guaranteed to grow every single year. Okay, it's contractually guaranteed. It's tax free, just like an IUL would be. Okay, assuming you set it up properly, you don't mech the policy. All right. Here's how it works: dividends. Again, remember, this is a whole life product, so we get dividends. It's not guaranteed every year, but this particular company has paid a dividend for 146 years straight. Okay. Pretty sure they're going to continue. All right. But what you can do is you can allocate a portion or all of your dividend that year to purchase call options on the S&P 500. And there's only one index. There's none of these volatility indexes or anything like that. It's just the S&P 500. That's it. We keep it real simple. All right. So you take your dividends, purchase call options. That's your risk right there. If the market goes down, you lose your dividend. But your policy still has that guaranteed growth rate at 3.25%. Okay. But the worst case scenario is just you lose your dividend for that year. Or the other thing you can do is you can allocate 50% of your dividend. Like you can control how much of your dividend gets is used to purchase these call options. So if you want to do half to make sure that you get some of your dividend credited to your policy that year, but then you know what, I want to roll the dice a little bit and take 50% of my dividend, put it into these call options. Okay, you could do that. And here's how the crediting works. At the time of this recording, might change, who knows? S&P, if the S&P goes up 5%, then you receive whatever your dividend would have been. So whatever you use to purchase the call options, if the S&P goes up at least 5%, that's just given back to you. Or if it goes up 5%, I'm sorry. If the S&P goes up 10% or more, you receive double your dividend, or however much you allocated to purchase the call options. That's pretty sweet. So if I'm getting a $5,000 dividend that year and the S&P goes up 10% or more, now I get a $10,000 dividend. That's pretty sweet in my book. And it's simple as well. Like, you know, pretty easy to digest there, pretty easy to comprehend. Now, there's a multiplier for like if the S&P goes up 7%, like you'll receive a little bit more than what your dividend would have been. But I'm keeping this simple, just trying to keep this as simple as possible right now. And a lot of the times when the S&P goes up, it is in the double-digit range. So you know, we're just keeping it simple here. All right, but that's how the crediting works, guys. We take your dividend, they purchase call options, goes up 10%, they double your dividend. That's it. So no cap rates that we have to worry about. No participation rates like IULs, which is just all over the place. No rising cost of insurance. We don't have to worry about that. We don't have to worry about net amount at risk. We don't have to worry about any of those things. No fees. This is because what's happening here is this is a rider that is added to the whole life policy. So you could choose not to do this. If you just want to receive your dividends whenever they're paid out, just do that. You don't have to do this. But if you want that upside potential, downside protection, and you're considering something like an IUL, here it is with all the guarantees and safety of whole life. There's no fees for the rider. There's an overloan protection rider that's included at no cost. So, you know, we're getting all of the like minimal benefits of IUL with like the upside potential, downside protection, but without any of the problems. So my question to you, okay, let's go back here. My question to you right now is, if that exists, why on earth would you buy an IUL? Why on earth would you sell an IUL if that exists? Please drop it down in the comments. I cannot wait to hear the feedback. All right. So that said, I'm going to go ahead and wrap this up. Those are the biggest issues that I have with IUL. I am not a fan. I will never be a fan, especially since there is an amazing whole life alternative to the promise of IUL, upside potential, downside protection. We still get all the tax advantages, all that stuff. Okay. And these policies are great for infinite banking, which I'm a huge fan of. All right. So either way, I would love to hear your guys' feedback. If you have any questions, all right, drop them down in the comments section below. All right. Make sure you check out the additional training in the description. Always have good stuff there for you guys. And I hope you're doing well. Hope you're crushing it. And I will talk to you in the next one. To your success, Matty Ice is out.